We have current tax and deferred tax, and we say that current tax is what we call corporation tax, the tax you pay each year from your normal business operations, you pay tax. Therefore, that is current tax, and in our previous class, we did some summary on it. Therefore, I'm not going back there because of the essence of time. We just want to go straight to deferred tax. That is where the examiner will want to ask you a lot of questions in deferred tax. Therefore, when we say deferred tax, these are taxes that are payable in future. As the word defer says, it means you are not paying it today, you postpone it until further dates. Like, for example, when I say you defer your course, it means that you are not doing it today, you will do it in the next semester. You are deferring this semester. Therefore, to defer means you will pay it in future. And why should we defer tax? That should be the question. Why should we defer tax? Now, remember, in the company, we are going to charge this tax on, deferred tax will be charged on assets and liabilities, as we are going to see. Therefore, remember, when you purchase the asset in the company, for you, you see it as an asset, but the taxman will see it as an economic benefit. Therefore, for example, you purchase an asset at 200 million. This is the value of your asset. The taxman will see 200 as the economic benefits. But for you, you see it as an asset. Remember, there's two conflicting rights there. Therefore, because the taxman has interest in this asset, the taxman will be keeping the record of this asset, as you also keep the record of this asset. Therefore, for example, at the end of the year, you as an accountant, you are going to depreciate this asset. You depreciate the asset as an accountant, and because the taxman also has interest in the asset, the taxman will not depreciate. The taxman always does not know what we call depreciation. The taxman knows what we call capital allowance on assets, capital allowance. Therefore, how will deferred tax arise on this? You as an accountant, for example, you are keeping a depreciation of 20% on this asset, 20% on this asset. The taxman is giving you capital allowance of 25% because for him, he don't know depreciation, but he knows what we call capital allowance, and this is standardized based on assets classes. For example, if it is class 1, class 2, class 3, class 4, like that, it is standardized. But for depreciation, it is not standardized. It depends with the policy of the company. Like, for example, I can purchase a pickup, and my good friend Waziri is also having a pickup, and my policy is I depreciate 10% on straight line, but my good friend Waziri is depreciating maybe 30% on reducing balance. Therefore, that one is not standardized on the same asset. But when you come to capital allowance, even if you are giving 30% reducing balance depreciation, the taxman will always give you the standard way. I believe from your taxes, you understand those classes. We have class 1 where we charge that 7.5 like that, and it transform. Therefore, the taxman will be keeping the record as you also keep the record of this asset. Therefore, at the end of the year, you as an accountant, you are putting 200 times 20%, depreciation is 40. Then at the end of the year, you will take 200 minus 40, you will report 160. This is your value as an accountant. When we go to the taxman, a taxman will take 200 times 25%, which is 50. Therefore, at the end of the year, the taxman will take 200 minus 50. Then he finds that the value is 150. Then we are going to compare those two values between the accountant and the taxman, and the difference is what will increase our tax or is what will reduce our tax. Therefore, for example, here, we have what we call the carrying amount is 160. Carrying amount is the amount reported by the accountant. Then we have what we call the tax base. We are going to discuss these two terms. The tax base, this is what the taxman holds. Therefore, we have 150. Therefore, the difference here is 10. Therefore, the taxman, remember, he knows very well that his value is very correct. Taxman knows very well that the value is very correct. Therefore, because his value is very standard, therefore he knows that this value is very standard. Then you are bringing 160 as your value. Therefore, the taxman will say, for me, I have 150, but this person is bringing 160, which means in future, this person will have more economic benefits. This person will have in future more economic benefits. Therefore, this term will be called taxable temporal difference. Taxable temporal difference. Taxable temporal difference. We are going to discuss those values, these terms in just a few minutes. Taxable temporal difference. Therefore, this, it means that in future, you will have more economic benefits. Therefore, the taxman will compute 10% times 30%, at 10 times 30%, you have the tax of 3. But this tax, you are not paying it today. Why are you not paying this tax today? Because you have not recovered the full value of your asset. Remember, you invested a lot of money in this asset, and you have not recovered the 200 or the 160 that is available at that time. It is you have not recovered that. You spend a lot of money. Then you cannot start paying tax, and then you because you have not recovered the value. That is why we say you defer tax to the future periods, and if you recover the value of the asset, is when you go to pay those taxes, those economic benefits that you are getting based on the valuation of the accountant and the valuation of the taxman. That is why we are going to compute deferred tax on assets and liabilities. And this is our point of concern at this point in time. Therefore, that is what we are going to do in the next 2 hours. In the next 2 hours, that is what we are going to do there. Therefore, what is deferred tax? Deferred tax in a simple language, in a layman's language, is tax payable in future, is tax payable in future. But in a complex language, we say that deferred tax is the tax consequences on assets and liabilities, on assets and liabilities. Based on the balance sheet approach, deferred tax is the tax consequences on assets and liabilities, because if I purchase an asset, it will either increase my tax or it will reduce my tax. That's why I'm saying it's the tax consequences on assets and liabilities. Therefore, how do I compute deferred tax? Now we are beginning now our program. You need to listen very carefully. Deferred tax equals to temporary difference times tax rate, Temporal difference times tax rate. If I want to get deferred tax, I will find first temporal difference. I'm going to explain what is temporal difference and why do we call it temporal difference. Therefore, if I want to get deferred tax, equals to temporal difference times the tax rate. Now, what is the temporal difference? Temporal difference equals to TD is the temporal difference. Temporal difference equals to the carrying amount of an asset. Carrying is the difference between carrying amount of an asset and the tax base. Temporal difference is the difference between the carrying amount of an asset and its tax base. Therefore, temporal difference equals to carrying amount of an asset minus tax base of this asset or liability. Temporal difference, I said if I want deferred tax, I will need the temporal difference times the tax rate. How do I get it? What is the temporal difference? This is the difference between the carrying amount of an asset or liability minus the tax base of an asset or liability. Therefore, I get the temporal difference. Now the question comes, what is the carrying amount? Carrying amount of an asset. This is the book value. This is the book value. Book value of an asset. This is the book value of an asset, or the amount of asset or liability, the amount of asset or liability reported in the balance sheet, at the end of the year, or at the end of any period. Carrying amount, we are first saying this is the book value of an asset or the amount of an asset or liability reported in the balance sheet at the end of the year. That is the carrying amount. Therefore, me now, we know what is the carrying amount, the book value. How do I get the carrying amount? I will take the cost minus accumulated depreciation. I get the CA, the carrying amount, cost of the asset minus the accumulated depreciation. I get the carrying amount. Or cost plus revaluation amount, then I get the CA. For example, if the asset is held at the revaluation model, for example, the cost is 200, I revalue by 20, therefore at the end I will put 220, the revalued amount, cost plus the revaluation, I get the carrying amount. Or if the asset is depreciable, I take the cost minus accumulated depreciation, I get what we call the carrying amount. Then we go to number 2. Number 2, what is the tax base? Tax base of the asset or liability. This is the amount. This is the amount of the asset or liability attributable for tax purpose. This is the amount of an asset or liability attributable for tax purpose. The amount of asset or liability attributable for tax purpose. Like for example, I said here on my asset of 200, the taxman will give me capital allowance of 50. Therefore, we have the difference. What is remaining is 150. Therefore, 150 is what we call the tax base, the amount that the taxman will attribute to tax, the amount that the taxman will attribute to tax. Therefore, like for example, he will take the cost of the asset minus what he's allowing you, he gets this amount. Therefore, this amount is what he's attributing to tax. Therefore, that is the amount attributable to tax, attributable for the tax purpose. That is the tax base of an asset or liability. I believe we know what is the deferred tax payable in the future in respect of taxable temporal difference. What is the temporal difference? The difference between the carrying amount of an asset and the tax base. What is the carrying amount of an asset? The book value of an asset. What is the tax base? The amount that will be attributable for tax purpose in the balance sheet. Therefore, we know what is deferred tax. Now, let's develop this concept again. Now, listen very carefully. When I take the carrying amount of the asset minus the tax base, I get what we call the temporal difference. For you don't write abbreviation like this because you might end up forgetting. For me, because I'm an expert in this, I will just know that this is not the chief accountant in the company, but is what? The carrying amount of an asset. This is not tuberculosis, because you might think that this is tuberculosis, but for Marimu, he will just know that This is the tax base. Then this is the temporal difference. Therefore, you need to write in full so that you don't forget when you are revising. When I take the carrying amount of an asset minus the tax base, I get what we call the temporal difference. Now, the temporal difference can either be taxable temporal difference or deductible temporal difference. Deductible temporal difference. It can either be taxable temporal difference or deductible temporal difference. Now, when it is taxable temporal difference, it will give us what we call tax liability. Tax liability. But if it is deductible temporal difference, it will give us what we call deferred tax asset. Deferred tax asset. If it is taxable temporal difference, it will give us tax liability in future. If it is deductible temporal difference, it will give us tax asset. Tax asset means that we shall recover tax from that. We are getting tax loss. We are getting a loss on that asset. Therefore, we shall recover that. Now, listen as we develop this concept. What is taxable temporal difference? Examiner might ask you, what is taxable temporal difference? This is the temporal difference that will result in tax liability in future periods. This is the temporal difference that will result in tax liability in future periods. What is deductible temporal difference? This is the temporal difference that will result in a recoverable amount in future periods. Now, let me show you something here. Let me show you something on taxable and deductible temporal difference. Let me show you something here. I believe you are following. Now, if I take the carrying amount of an asset, let me assume the carrying amount is 200. Then the tax base of an asset, let me assume it's 100. I get what we call the temporal difference. Temporal difference is 100 because I'm taking 200 minus carrying amount minus this, I'm getting 100. Now, listen, I explain what is taxable, what is deductible. Now, in this case, according to the taxman, the asset needs to be 100. According to the taxman. Or let me use 150 so that you don't confuse, because I don't want here 100, here 100. Let me use 150 so that the temporal difference becomes 50, like that. Now, according to the taxman, the temporal difference is, and the tax base is 150. According to the accountant in your books, the carrying amount is 200. The carrying amount is 200. Therefore, here, according to the taxman, this company will have more economic benefits in future because his value is less. If you sell this asset today, you are going to realize the profit of what? 50. If, for example, my good friend Florence, you decide to sell this asset, the taxman will say you are selling it at 200, while his value is only 150. Therefore, according to him, you are making profits from this asset. Therefore, this one becomes what we call taxable temporal difference. It becomes what we call taxable temporal difference. You say, please, you don't have to ask for permission, or you want to be muted, Florence. Let me mute Florence. You can now ask.
Yes,
Florence?
I'm asking.
Yes.
What is the formula that I can use when getting temporary difference? Is it tax base minus carrying amount or carrying amount minus tax base?
Carrying amount minus tax base.
Okay.
Yes, what Marin is doing here, carrying amount minus tax base, we get what we call temporal difference.
Okay.
Thank you. Okay, now let's continue. And if you have a question, you don't ask for permission, you can just put in the chat, or if you want to maybe ask verbally. That is when we can unmute you and ask. Now, what we are saying, when I take the carrying amount minus the tax base, I'm getting the temporal difference there. Now, because the taxman is having less amount, it means you as a company, you are making profit in future. Therefore, this one becomes what we call taxable temporal difference. Now, let's come to scenario number 2. The carrying amount is 100. The tax base is 120. The tax base is 120. The carrying amount of the asset is 100. The tax base is 120. The tax base is 120. Therefore, we have a difference of 20. But now, listen very carefully. According to the taxman, the asset needs to be what? 120. The asset needs to be 120. But according to the accountant, he is presenting 100. Therefore, it is less than what the taxman expects. The carrying amount is less than what the tax base and the taxman is expecting. Therefore, this one, it means the company is making a loss. Therefore, this one, we call it deductible. Deductible temporal difference. We call it deductible temporal difference. And now, the effect is, if it is taxable temporal difference, we shall pay tax on it. We shall have tax liability. If it is deductible temporal difference, then it means we shall have to recover tax asset. Tax asset, we shall have to recover in future. We shall have to recover in future. That is what I'm explaining. That is what I'm explaining. Now, let's come to, for example, it's a liability. Listen very carefully so that you don't forget these items, very good items. Let's come to, this was asset. Asset A, asset B. This is liability A. Liability A has the carrying amount of 300. Liability A has the carrying amount of 300 and the tax base of 200. The tax base of 200. So 20 negative will be pay tax on it in future. Florence. So that 20 we will pay tax on it in future. Florence, listen very carefully. I'm saying if it is 20 negative, it's a deductible temporal difference. I'm saying it is a tax asset. We shall recover tax. That's what Marim is saying. If it is 20 negative, we are going to recover. It's a tax asset. Tax asset means KASNEB will give us back. That is why I'm saying deductible temporal difference, tax asset. But if it is 50 here, I say it is taxable temporal difference. It is a tax liability. We shall pay in future. That is what Marim is saying here. I believe you are getting that concept, Florence. Marim, even he has written here, don't confuse. Marim is writing that this negative 20, deductible temporal difference, tax asset. Tax asset means we shall recover. If it is in the first scenario, taxable temporal difference, tax liability. Tax liability, what does it mean? You are required to pay to KRA. Now let's go to liability A. Liability A has the carrying amount of 300, the tax base of 200. We have a difference of 100. Now listen, will this be taxable or deductible? Listen very carefully, kindly. We have liability. Remember, these two are assets. Now we are on liabilities. Liability A has the carrying amount of 300, tax base of 200. Temporal difference is 300. It's 100. Now the thing is, remember, according to the taxman, he expects the liability to be 200. But for you, you have more liabilities. Your liabilities are more than what the taxman is expecting. Therefore, you are making a loss. If liabilities increase in the company, you are making a loss. Therefore, this one becomes what we call deductible. Deductible, temporal difference, we shall recover tax, we call it tax asset. Tax asset. Because liabilities are increasing, that is deductible, temporal difference, we shall have tax asset. Then we have liability B. Here it is 150. When we come here, it is 180. The carrying amount is 150. When we go to the taxman, it is 180. Therefore, we have the difference of 30. Now, according to the taxman, your liabilities in the company needs to be 180. But in your books, you are having less liabilities. Therefore, it means that your liabilities are reducing. And whenever liabilities reduce, my good friends, it is what? It is a gain to the company. This is the word gain to the company. If liabilities reduce, it is a gain to the company. Therefore, in this scenario, the liabilities are reducing. Therefore, it becomes gain to the company. Therefore, this is taxable. Taxable, temporal difference. You are required to pay tax in future. You are required to pay tax in future. You are required to pay tax in future. That's what we are saying. Defer tax. First, we defer tax, we need temporal difference. Then we multiply by tax rate. This temporal difference can either be deductible or taxable. And this is the scenario of what Marimu has explained in detail, if it is taxable or deductible. Now, examiner can ask you, what is tax liability? What is tax liability? Tax liability, what is deferred tax liability? Deferred tax liability. This is what you say. Deferred tax liability, this is tax payable in future periods, payable in future periods, in respect of taxable temporal difference. Tax payable in future periods in respect of taxable temporal difference. I believe that one we are okay. When we are asked what is deferred tax liability, what's a tax liability? Tax payable in future periods in respect of taxable temporal difference. Then what is deferred tax asset? It may look very simple what Marim is doing, but remember at some point you will find KASNEB asking you such a questions, then you become stuck there. But if you are in my class, you will not be stuck, of course, because Marim is making them very simple here. What is deferred tax asset? Deferred tax asset, this is tax recoverable. Recoverable in future periods in respect of, we have three things there we are going to discuss, be careful. In respect of number one, deductible temporal difference. In respect of number one, deductible temporal difference. In respect of number two, carry forward of unused tax losses, carry forward of unused tax losses, carry forward of unused tax losses, carry forward of unused tax losses. Then number three, carry forward of unused tax credits. carry forward of unused tax losses, and carry forward of unused tax credits. Therefore, if we have tax losses, it means that we shall recover those tax losses, we shall recover tax in future. If we have tax credits, then we shall recover tax in future. Now, the question comes to my good friend Florence. What is the difference between a tax loss and a tax credit? That is a very good question to my good friend Florence. The field is yours, Florence. What is the difference between a tax loss and a tax credit? Because we are saying carry forward of unused tax loss, carry forward of unused tax credits. What is the difference? Now, to help my good friend Florence, when we talk of tax losses, for example, in previous year, I can see Florence tax loss when a company is making losses. Thank you very much. That is perfect. For example, this is what I'm going to explain. For example, in the previous year, you made a loss of 60 million. You made a loss of 60 million. You are going to compute 30% of it. Therefore, tax loss is 18 million. Tax loss is 18 million. Therefore, in the current year, now this was in the previous year. Listen very carefully. This was in the previous year. In the current year, I make profit of, let me say, profit of 50 million. I have a profit of 50 million. What is the tax there? Tax there is times 30%. Therefore, my tax there is 15 million. I'm required to pay tax of 15 million. Now, when I go to KASNEB, I find that I already have the tax loss of the previous year. Therefore, they will take 18 minus 15. I'm remaining with 3 million loss. Therefore, I'm not paying anything. We are offsetting the profit and the loss. Therefore, that was an asset to me because it's reducing the tax liability I'm required to pay. That's why we are saying tax asset. It is reducing what I'm required to pay. I'm required to pay 15, but already I made a loss in the previous year. Therefore, I still have a loss of 3 million. Therefore, in the next year also, I'm going to recover the same. In the next year, for example, I make the profit, next year profit of, let me say again 50 million times 30. Therefore, I'm required to pay 15. Then they will less 3 million. Therefore, I only pay 12 million of tax. I only pay 12 because I'm recovering the tax losses of the previous year. That's why we are saying it's an asset. Now, what is a tax credit? Tax credit is when you overpaid tax. For example, we were discussing what we call over and under provision. Therefore, you overpaid tax. Let me say instead of paying 200, you paid 250. Therefore, you overpaid by 50. Therefore, 50 becomes a tax asset. When you got next year to pay, for example, you are required to pay 300 in the next year, but you already overpaid by 50, therefore you subtract 50 there, you only pay 250 because you overpaid. That is the difference between a tax credit and a tax loss. Therefore, if you overpaid tax, it becomes an asset to you because it will reduce your taxes in the future. That is how we are going to determine if it is taxable temporal difference or deductible temporal difference. For those who are joining now, we are doing a topic called income taxes. And in this full topic of income taxes, we are discussing deferred tax. Deferred tax is tax payable in future periods. If you are joining today, my name is called CPA Wabomba. CPA Wabomba has a lot of experience in financial reporting. I started teaching financial reporting in the year 2012. Therefore, I have 12 good years in teaching advanced financial reporting. Therefore, whatever Mwalimu will be telling you, you need to get it very well because it will be tested in exams probably. And also, Mwalimu is an examiner. Therefore, if Mwalimu is telling you something, you need to be very attentive and listen very carefully because whatever we are doing in class, is what will be tested. Is what will be tested. The experience we have in this field is not a joke. The experience is not a joke. Therefore, what we are saying is that here we are going to calculate deferred tax. Now, to get the carrying amount of an asset, is very easy. You as an accountant, I believe you are very good accountants. Therefore, to get the carrying amount of an asset cannot be an issue. But the issue will come how to determine the tax base. Now, what Mwalimu wants to do to you, for you, is to give you the summary of how are you going to notice that this is the tax base in the question. For example, the examiner has given you the statement. In that statement, how will you know that this is what is making up the tax base and this is what is making up the carrying amount? Therefore, I want to give you the summary of how to determine the tax base. The summary of how to determine the tax base of the asset or liability. How are we going to determine the tax base of an asset or liability? I just want to give you a very good summary. In this one, it's not in the standard, but because of the experience we have in these matters, I can be able to tell you that if you do these things I'm telling you, then when you read a question, you will be able to identify that this is the tax base of an asset. How are you going to compute the tax base of an asset? Because that is the weird thing in this topic. That is the most complex item in this topic. But if you understand it, and now that you are in my class, I believe you will understand it very well. Then at the far corner of your book, say tax base. See what Marine is doing? At the far corner of your book, say tax base. Then we come to number one. We come to item number one. What will be our item number one? I have what we call non-current asset. How will I determine the tax base in the non-current asset? We said this. The non-current asset, NCA is non-current asset, is depreciable, subject to capital allowance. Non-current asset is depreciable and subject to the capital allowance. The tax base is the written down value. The tax base is the written down value. I believe you are getting it. How do you get the written down value? Remember, I'm saying if the non-current asset like PPE, like buildings, is depreciable and it's also subject to capital allowance. Therefore, for example, I have PPE of 200 million. This PPE is depreciable and it's also subject to capital allowance. The taxman does not know what we call depreciation. He knows what we call capital allowance. Therefore, as I already said, the depreciation is 20%. Capital allowance is 25%. I already said this, I'm just repeating for understanding purpose. Therefore, for me to know the tax base of this asset, I will check what is the taxman offering to me as an allowance. The taxman is offering me 25%. Therefore, I will take 200 times 25%, I get 50. That is the capital allowance. Therefore, when I take the cost 200 minus 50, I get what we call 150. This is what we call written down value. value. According to tax, this is written down value. And that is what will make the tax base of an asset. Therefore, what Mwalimu is saying, when you are reading a statement, just for you to identify the tax base, just check, is the examiner giving me the capital allowance on this asset? If yes, then take the capital allowance minus the cost of the asset to get the written down value, which will be the tax base. Is that okay? Yes, it's okay. It's okay. Let's go to number 2. Let's go to item number 2. Current asset. Item number 2 is the current asset. Then we say number A here, current asset subject to specific provision, subject to specific provision, subject to specific provision. The current asset is subject to specific provision. The tax base is same as carrying amount. The tax base is same as carrying amount. Same as carrying amount. The tax base. Mwalimu, are there items in NCA that do not qualify for the tax base? Yes, they are. They are. If the asset, for example, if it does not qualify for capital allowance, then it doesn't qualify for tax base. If it's an exempt asset, for example, if there is no tax liability on it, then it will not. But if the examiner is asking you in this, he will be categorical that the tax base, the capital allowance on this asset is 25% or 50%. Advise me on goodwill. Goodwill does not qualify for taxation. I will explain why as we are moving, we are going to something. We are going there, Florence. I will advise you on goodwill. Thank you very much. I will advise you on goodwill. I will advise you on goodwill. I will advise you on goodwill. Therefore, what I'm saying, if the current asset is subject to specific provision, then the tax base is the same as the carrying amount. What I'm saying, my good friend Flores, is that, for example, I have the carrying amount, the tax base, then temporal, different. Therefore, the carrying, I have, for example, my asset as 200. Therefore, this asset is subject to specific provision. Subject to specific provision, then it means that the tax base will also be 200. Therefore, the temporal difference is nil. Temporal difference is nil there. Temporal difference is nil there. That is what Mwalimu is saying. Now, what are the examples of current asset? Examples of current asset are: number 1, inventory is a current asset. Number 2, receivable is a current asset. Number 3, cash is a current asset. Number 4, bank balance is a current asset. Number 5, prepayment is a current asset. Therefore, I'm saying that current asset subject to specific provision, the tax base is the same as the carrying amount. Let me go to number B, then I explain in wholesome what is specific and other provisions. Current asset subject to general provision. General provision. Then the tax base is the gross amount. The tax base is the gross amount. Tax base is the gross amount. If it is subject to general provision, the tax base is the carry, and tax base is the gross amount. Now, let me explain what is general and specific provision. Listen very carefully to Mwalimu here, because I want to elaborate on something. Now, let's assume you have 10 customers. You have 10 customers. And out of 10 customers, these are people you gave your money. You gave out your money. You gave to Mwalimu, you gave to another person there. Therefore, those are your customers. You lend money outside. You have 10 customers, but by bad luck, one customer is not there. One customer is not there. For example, by bad luck, he has died. By bad luck, he has died. Therefore, if, for example, you are preparing your balance sheet, you know that these customers, maybe total amount is 300 million. But the person who has died, he had 20 million. He had 20 million. The person who has died, he had 20 million. Therefore, if you are preparing your financial statement, you will take 300 minus 20. Therefore, you are having 280. And you have evidence that this person died. Therefore, if you provide for this one, the carrying amount of your receivable will be 280. When you go to the taxman, you have the evidence that this person died. Therefore, the taxman will also agree and say, if you present 200, this person died, I will also say 200. Therefore, there will be no tax implication there. There will be no tax implication. That's an allowable expense. Specific provision is an allowable expense. But the reverse is also true. For example, you have 10 customers. Listen very carefully. You have 10 customers, and maybe in the previous year, 4 customers did not pay. 4 customers in the previous year did not pay. Then you assume that because in the last year 4 did not pay, maybe this year 4 again will not pay. You are just assuming that maybe this year again 4 will not pay. Therefore, what do? You provide for those 4. Let's assume that this 4 total is 300. Those 4 amounts to 60 million. 60 million. Therefore, at the end, you are providing for, remember, that's a general. You are not specific if they are alive, they are there, they are not declared bankrupt, but you are just bringing because last year 4 did not pay, maybe this year also 4 will not pay. Therefore, you are just generalizing. Therefore, maybe let's say total is 60. Therefore, when you are reporting, what will you do? You will take total receivable minus 60. Therefore, you are getting 240. Then you as an accountant, you are going to report 280. There are 240. You as an accountant, your carrying amount at the end of the year is 240. Now, out of this 240, when you go to the taxman, he will ask you where is the evidence? Where is the evidence? Then you will start, the previous year. Then he says, wait, I will not accept that. Therefore, he will add back the 60 so that it remains 300. The gross amount is 300. Therefore, the temporal difference will be 60 but deductible. Therefore, the taxman will not accept a general provision. That's why we are saying if the current asset is subject to specific provision, the tax base will be the same because the taxman will agree 100%. But if it is general provision, the taxman will not accept that provision. But for you, based on IAS 37, contingent liabilities, you are going to provide for it. But the taxman will not agree with that. He takes it back. He takes what was the gross amount? It was 300. That is why I'm saying if subject to general and that you need to understand because we'll be reading them in a question. For example, examiner has given you a statement. You need to check, is it specific provision or general provision? This is where if you don't get this summary that we are saying, then forget about deferred tax. It will be complicated for you. But if you understand what Marim is saying, then deferred tax, you will even wish that the examiner brings 4 questions on deferred tax. Let's go to item number 3. Item number 3, we are talking about investments. Item number 3, we are talking about investments. Then you put a dash and say, for accounting purpose, Investments are recognized at fair value. For accounting purpose, investments are recognized at fair value. Then you put another dash and say, for tax purpose, investments are recognized at cost. Investments are recognized at cost. Then what will be the tax base on investment? I'm saying Mwalimu, that thing by name available for sale falls under investment. Yes, that's an investment in financial assets. We are going to discuss it after this. We are going to discuss financial assets and financial liabilities. Available for sale is an investment. Therefore, what I'm saying, for accounting purpose, investments are recognized at fair value. For tax purpose, investments are recognized at cost. Therefore, the tax base of investment is their cost. If you read these two statements, it will tell you that the tax base on investment is their cost, because for tax purpose, investments are recognized at cost. Let me explain something before we move on. Now, for example, I have my investments. I want to invest in financial assets. I'm going to the stock exchange to invest in financial assets. How much money am I going to invest? I'm going to invest 200 million. What I'm investing is what I'm calling the cost of that investment. When it comes at the end of the year, these investments have increased in value. Maybe they are at 230 million. I invested 200. But when it comes at the end of the year, when we revalue this, it comes at 230. Therefore, for you, when you are reporting as an accountant, Marim is saying, if you are reporting in your books as an accountant, you will report the fair value. Therefore, your CA will be 230. That is what you report as an accountant. But when we go to the tax man, he will ask you, what was the cost of this investment? Then you say, oh, I purchased this investment on 1st January by 200 million. Then he say, okay, that is what I know, 200. Then there is a temporal difference of 30. Therefore, what we are saying is that the tax base on investment is its cost. Is its cost there. I believe we are moving on well, because I said, if you don't understand at this point, then deferred tax will be an elephant in the room. And remember, it will only be an elephant in your room, not in any other room. Because in other rooms, it will be very easy, but it will be an elephant in your own room. Therefore, make sure that you are understanding it at this point in time. If you have a question like what Florence is having, just put it in the chat. We shall solve it as it comes. Now, let's go to another item. Let's go to another item. Another item, as I told you, I know you will pass, Florence. You don't have to worry. That is why we are here. That's why you paid to be in this class. That is why you paid to be in this class. Now, does revaluation falls here in investment? Revaluation will come on PPE. I will also explain something on revaluation as we move on. As we are going to explain something on revaluation. I'm going to explain revaluation. Don't worry. I'm going to explain revaluation. Let's go to number 4. Let's go to number 4. Let's go to number 4. Number 4, we talk about intangible assets. And development cost. Intangible asset and development cost. Intangible asset and development cost. Now, the tax base on intangible asset and development cost is always nil. Is always zero. I'm saying the tax base on intangible asset and development cost is always zero, nil. What am I saying? For example, I have the carrying amount, I have the tax base, and I have the temporal difference. Now I have an intangible asset here, 200. The tax base will be zero. Therefore, this is 200, temporal difference is 200. That is 200. Now, why am I saying that the tax base on intangible asset is nil? First, what is an intangible asset? This are an asset that does not have any physical substance. The asset that does not have any physical substances. Like, for example, when you are making a project, imagine you are making a project. When you are making a project, you are incurring some cost. Listen very carefully to this story. When you are developing a project, you are incurring costs on this project. Now, after incurring this cost, let me say costs total to 50 million. The cost total to 50 million. When you are preparing your current tax, listen very carefully. When you are preparing your current tax, you will charge this 50 million as expense. As expense, same as salaries, same as rent. Then the taxman will allow you. The taxman will say, okay, we got to develop a project, it's okay. That one is okay. It's an expense, I'm allowing you. After the taxman has allowed you that expense, you come back in the company and capitalize. You make it an asset. You make 50 million cost to be an asset. You report it as an asset in the balance sheet. Therefore, the moment the taxman will see this 50 million on this intangible asset, and he already allowed you as an expense, then he will say, look at this person. This thing I allowed him, but he's putting here as an asset. Therefore, there is a lot of economic benefits we are expecting from this asset. Then he says the total amount needs to be taxed. That is why we are saying the tax base is zero, because the taxman already allowed you, but for you, you deemed it fit to make it an asset in your balance sheet. Therefore, it will be taxed that way. That is why I'm saying in simple language, the tax base is zero. Whenever you have the intangible asset. And by the way, you need to understand what are the intangible assets. Intangible asset comprises items like patents, trademarks, like goodwill, copyrights, franchise, brands, customer list. Those are examples, trade license. Because you need to know them. Because in our question, examiner will pick one asset and say, trade license or software. Therefore, you need to know what are intangible assets first. You go to IAS 38 and read what are the examples of intangible assets. When you go to IAS 38, you will get all of them. Therefore, that is what Mwalimu is saying. Now, you talked about goodwill. My good friend Florence talked about goodwill. Now, goodwill is not allowable expense the same way we are talking about other intangible assets. Goodwill is not recognized by tax. Goodwill is not recognized by tax. Therefore, it is always a tax exempt. It's always a tax exempt, or it's an allowable expense. A non-allowable expense. Therefore, if you subtract it, the taxman will take it back. The taxman will take it back. Therefore, there will be no tax effect on goodwill. there will be no tax effect on goodwill because the taxman does not recognize that goodwill. Remember, goodwill is a loss in the company, but you also capitalize that. When you are preparing your financial statement for tax, the taxman will not agree to it. The taxman will not allow you that cost of goodwill. The taxman will not allow you that cost of goodwill. I said I will explain. Now I'm explaining as we move on. I have explained goodwill. Let's go to the last item. Last item before we go for a break. Last item, number 5. Last item is number 5. Last item is number 5. Last item is number 5. Number 5 is we say number 5. We say liabilities arising as a result of accrued expenses. Liabilities arising as a result of accrued expenses. Number A, liabilities arising as a result of accrued expense. Number A, if non-taxable or non-deductible. If non-taxable or non-deductible, then the tax base is the same as the carrying amount. Same as carrying amount. If it is non-taxable or non-deductible, the tax base is the same as the carrying amount there. Number B. If taxable or deductible on settlement or when cash is paid out. If taxable or deductible on settlement or when cash is paid out, the tax base is nil. The tax base is nil if taxable or deductible on settlement or when cash is paid out. The tax base is nil. The tax base is nil. The tax base is nil. That is the summary of how we are going to recognize or to determine the tax base of assets or liability. Now, like in this last statement, we are saying, for example, you have liabilities like payables. Then the examiner is saying, we have this payable. This payable is only taxable or deductible when cash is paid out. When cash is paid out. Then you don't ask yourselves questions. You just say, Marimu said that if the expense is taxable or deductible on settlement when the cash is paid out, the tax base is nil. You make your life very easy. 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 Therefore, let's have a short break, 5 minutes break, just 5 minutes break. When we come back, we do something small on the revaluation of assets, something small on the revaluation of assets. After revaluation of assets, then we start doing questions. Therefore, let's have a break of 5 minutes, just 5 minutes. Okay, thank you. We can proceed. Okay, let's look at something small on revaluation. Then you say this, on the revaluation, you say this, when assets are revalued, the tax effect on revaluation, surplus or deficit should be computed, and transferred to deferred tax account. When assets are revalued, the tax effect on revaluation surplus should be computed and transferred to deferred tax account and transferred to deferred tax account. Therefore, the moment you revalue an asset, therefore you are required to determine the tax effect on your revaluation. Like for example, during the year, you revalue the asset. During the year, you revalue the asset. Let me say, for example, revaluation, the asset is 200. Then you revalue 2,000. You revalue this asset by 2,000. Therefore, it means that when you revalue the asset, you are required to debit asset account. You credit revaluation reserve account. You credit revaluation reserve account. Then there is tax effect on this revaluation. Therefore, with tax effect on the revaluation, a debit revaluation account, you credit deferred tax. That's what we are saying. If, for example, you have revalued the asset, then you are required to compute what is the tax effect on this asset. After you compute the tax effect on the asset, you take it to deferred tax account. If there is any revaluation on the asset. You are going to transfer that revaluation to deferred tax account. Let's begin with the questions now. Let's begin with September 2021, question number 4. That's our first question. September 2021, question number 4. Let's go to September 2021, question number 4. September 2021, question number 4. September 2021, question number 4. I believe you are looking for the question. September 2021, question number 4. Oh, my name is already there. If you are there, you say yes. And remember, when you are in our class, remember to read notes. We have notes on our WhatsApp. I believe our good friend Waziri will share them. We have notes on our WhatsApp. Therefore, make sure, like the notes we are discussing on deferred tax, when you go to our notes on our handout, you will get the full notes. What is temporal difference? What is deferred tax? You will get the notes there, the summarized notes there. Therefore, make sure you utilize them for this purpose. Don't just be in class to listen, because of course you will forget. But if you combine with the notes, which handout is that, Florence? And then you are new on our WhatsApp, we shared, and I believe you know very well, we shared the notes and we have been sharing like a small handout, but it has like everything. A small handout, but it has like everything. We shall reshare that for your purpose. This question number 3, sorry, question number 3, not 4. Question number 3, not 4. Question number 3. It's not question number 4, number 3. It says like this. With reference to deferred tax, differentiate between permanent difference and temporal difference. Permanent difference we already explained in our previous class, and when you go to our notes, it is there. My good Florence, friend Florence, I will share, you will see it. We already said that. Temporal difference, we already said it. Let's go to number 2. Huruma Limited, a public limited company, has a portfolio of investment, including various subsidiaries, and also undertakes various projects varying from debt factoring to investing in property and commodities. The following information was extracted from the group financial statements relating to the deferred tax provision for the year ended 31st March 2021. March 2021. We have number one. Huruma Limited acquired a controlling interest in the subsidiary Sukari Limited on 1st July 2020. The fair value of the assets and liabilities acquired were considered to be equal to their carrying amounts with an exception of freehold property, which had their fair value of 256 million and a tax base of 248 million. The directors of Huruma Limited have no intention of selling the property. Number two, during the year ended at 1st March 2021, Huruma Limited sold goods at a price of 48 million to another subsidiary, Wingu Limited, and made a profit of 16 million on the transaction. 40% of these goods were held in the inventories of Wingu Limited as at 31st March 2021. Number three, Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current assets for financial trading purpose. These investments are stated at fair value in the statement of financial position, with any gain or loss taken to profit or loss. These gains or losses are taxed when investments are sold. Currently, the investments have a market value of 412 million and accumulated an realized gain of 64 million. Number four, Huruma Limited's loan asset had a carrying amount of 168 million after an allowance for credit loss of 32 million based on 12-month expected credit loss. Tax relief is only available when the specific loan is written off. Number five, Huruma Limited has unrelieved trading losses of 20 million as at 1st March 2021. These unrelieved tax losses arose from a one-off restructuring exercise carried out during the financial year and is highly expected that taxable profits will be available in the future. Number six, on 1st April 2020, Huruma Limited deferred tax account had a nil balance, assume a corporation tax rate of 30% required, determine the deferred tax asset or liability for Huruma Group for the year ended at 1st March 2021 in conformity with IAS 12 income taxes. 8 marks there. 8 marks there. 8 marks there. 8 free marks. Let me call it 8 free marks. Now we want to look at this question in detail. We want to look at this question in detail. Thank you very much. I have seen you have shared the handout and the notes. Thank you very much. Thank you very much for that kind response. Thank you. I will have shared. Therefore, the notes are in this one, as you can see, AFRA class notes. Those are my notes. Therefore, you make sure that you utilize them for the purpose of our classes. Those are just my brief notes I prepared. Therefore, make sure that you utilize them for this purpose, and everything shall be okay. Everything shall be okay. Therefore, let's look at this question. Examiner wants us to determine deferred tax. Examiner wants us to compute deferred tax. Therefore, let's see how are we going to compute deferred tax here. Let's see how we are going to do deferred tax here in the question of September 2021, question number 3. Okay, we say that is September 2021, question number 3. Now we say deferred tax equals to temporal difference times tax rate. That is where we began. I'm just taking us back so that we analyze this concept. Temporal difference equals to carrying amount minus tax base minus tax base. Temporal difference equals to carrying amount minus the tax base, minus the tax base. Minus the tax base. Now, for me to determine the tax base, I'm going to say item. Then I determine what is the carrying amount, what is the tax base, then what is the temporal difference. We say item, carrying amount, tax base, and the temporal difference. Now we go to note number 1, that is our point of where the point of concern is. Note number 1, where the point of concern is. Note number 1. Huruma Limited acquired a controlling interest in a subsidiary Sukari Limited on 1st July 2020. The fair values of the assets and liabilities acquired were considered to be equal to their carrying amount, which with an exemption of freehold property, which had a fair value of 256 million and the tax base of 248. Now, in the asset, we have here freehold property, freehold. The taxman will always recognize that the carrying amount is the fair value, 256. That is the carrying amount. We said in the asset, we are going to report the fair value. As an accountant, always report the fair value. Then the examiner is telling us the tax base is 248. In some instances, examiner will not give you the tax base of 248, but he will calculate the question so that you determine it yourself. And I already said, if the examiner gives you the capital allowance, then you take the cost minus the capital allowance to get the tax base. Then our temporal difference, who can give us the temporal difference? Temporal difference in this case, 256 minus 248. And when you give me the temporal difference, you tell me if it is taxable or deductible. You tell me if it is taxable or deductible. This is 256 minus 248. 8, but taxable. 8, but taxable. I'm taking the difference between the carrying amount and the tax base. I get 8, but it is taxable. Taxable. When you give me 8, you tell me if it is taxable or deductible. That is note number 1. We are done. We are done with note number 1. We are done with note number 1. Then we go to note number 2. It says, during the year ended at 1st March 2021, Huruma Limited sold goods at a price of shillings 48 million to another subsidiary, Wingu Limited, and made a profit of 16 million on the transaction. 40% of these goods were held in the inventories of Wingu Limited as at that 1st March 2021. Now, in note number 2, we have what we call inventory. We sold goods. Here, examiner is saying a very simple thing. Examiner is saying a very simple thing. Listen so that you understand what the examiner is saying. During the year ended at 1st March 2021, Huruma Limited sold goods at a price of shillings 48 million. Selling price of goods. Selling price was 48 million. Was 48 million. Listen very carefully. 48 million to another subsidiary, Wingu Limited, and made a profit of 16 million on this transaction. 40% of these goods were held in the inventories. Therefore, out of this sale, 40% were unsold. Therefore, what I need to report as my stock is the 40%, not 48, because 48 was the selling price. But out of that selling price, 40% of these goods were still in the inventory. 40% of these goods were still in the inventory. Then what do we do? Me as an accountant, remember this is group accounts. When we go to group accounts, you will deeply understand this very well. When we go to group accounts. Now listen, this company sold goods to another subsidiary, parent, subsidiary relationship. Therefore, the parent sold the goods to the subsidiary. I believe up to today, you understand what is the parent, what is a subsidiary. Therefore, the parent company sold goods to the subsidiary at a profit. The selling price was 48, and they made a profit of 32. Therefore, at 16, therefore the difference is 32. Therefore, the cost of these goods to the parent was 32. Therefore, if the parent wants to report these goods, it will not report by plus the profit. We have what we call an unrealized profit on closing stock. Unrealized profit on closing stock. When we go to group accounts, we shall understand more. Therefore, the parent will report these goods minus the unrealized profit, minus the profit. But when we go to the taxman, he will report goods plus the profit. Taxman, because taxman will see the sale of goods. You sold the good, you transferred goods that was a sale. That's according to the taxman. But the accountant or the parent company will say, I sold to my brother. Therefore, I'm not reporting that profit because it's like I sold to myself. I will not report the profit. Therefore, the carrying amount will be 32 times 40% of the goods. When we go to the tax base, the taxman will see 48 times 40% of the goods. That is how we are going to recognize as the parent, we shall subtract the profit on the sale of goods because that was not a sale and a realized profit. But the taxman will see you transferred the goods. Therefore, I recognize 48, but now the goods that are still in the inventory is only 40%. Therefore, I will take 32 times 12.8. The taxman will be 19.2. $6.4, but deductible. 6.4, but deductible. When we go to group accounts, you will enjoy listening to that concept because you will understand it more, where the parent has sold goods to the subsidiary we call at a profit. Then these goods are not sold to the outsiders. We call it an unrealized profit on closing stock. Let's go to note number 3. Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current assets for financial trading purpose. These investments are stated at fair value in the statement of financial position with any gain or loss taken to profit or loss. These gains or losses are taxed when the investments are sold. Currently, the investment have a market value of 412 million and accumulated an unrealized gain of 64 million. We have financial assets there. Financial assets. Now, in this financial asset, examiner is telling us that the market value, the fair value of this financial asset or investments is 412. That is what we have at the market value. As an accountant, I will report what I have at the current value, market value, fair value, blah, blah, blah. As an accountant, that is what I report in my books as an accountant. I report what is the fair value. But when we go to the taxman, he will report the cost of this investment. Therefore, when you read this statement, I want you, my good people, to tell me, when you read this statement, what is the cost of this investment? Now, the question is to you guys. What is the cost of this investment? What is the cost of this investment? Help Mwalimu there understand the concept. What was the cost of this investment? Thank you, Florence. 412 minus 168. Thank you very much. 412 minus, not 168. 412 minus 64. 412 minus 64. Florence, it is 412 minus 64. 412 minus 64. Because as an accountant, we are reporting this, but remember, this includes accumulated gain. It includes accumulated gain. Accumulated gain. Therefore, it will be 412 minus 64. Therefore, we get 348 as not quitting. Not quitting. I need to know your real name. Not quitting. Not quitting. 348. Therefore, this is 348. Therefore, the difference is 64, but taxable. The difference is 64, but taxable. Taxable there. If we are moving on well, if you have any question, just put it in the chat. We go to note number 4. Huruma Limited's loan asset had a carrying amount of 168 million after an allowance for credit loss of 32 million based on 12-month credit expected credit loss. Tax relief is only available when the specific loan is written off. We have here the loan asset. What is the carrying amount of this loan asset? Examiner is saying that we have the carrying amount of 168. 168. Carrying amount is 168. What will be the tax base? What will be the tax base of this loan asset? What will be the tax base of this loan asset? What will be the tax base of this loan asset? What will be the tax base of this loan asset? The question is to you guys. 200. Thank you very much, Kamakai. Thank you very much. Now remember, we reported this after the loss. After the loss, we reported 168 after the loss. Therefore, remember, loan asset is an investment. Loan asset is an investment. Therefore, if we reported 168 after the loss, then it means that the total was 200. We add back, we take 168 plus 32 loss, which is 200. Therefore, here we have 32, but deductible. Deductible. 32, but deductible. Then we go to the next note. Next note is note number 5. Huruma Limited has an relieved trading loss of 200 million as at that 1st March 2021. These unused tax losses arose from one-off restructuring exercise carried out during the financial year, and it is highly expected that taxable profits will be available in the future. Therefore, here we have trading losses. Trading loss or tax loss. What is the carrying amount of this tax loss? What is the carrying amount? I want my good friend Edwin. Edwin, I have mentioned the name Edwin 2 times. Therefore, kindly give me the carrying amount of this item. Give me the carrying amount of this item, tax loss. My good friend Edwin. Give me the carrying amount. Anyone else? Anyone else? To give me the carrying amount. Florence, you say nil. Thank you very much. Now, when you have a tax loss, listen very, very carefully. When you have a tax loss, for you as an accountant, you don't recognize the tax loss in your books. You don't recognize the tax loss in your books. It is only the taxman that will keep the record of this, so that when you file the next returns, you go and offset it in the tax base. Therefore, here, the tax loss in the accountant books is zero. You don't keep the record and say, now in the previous year I made a loss, therefore I have an asset. No. It is the taxman that is keeping the record. The taxman that is keeping what? The record. Then when you go to the tax base, he has 20. He has 20. Therefore, the temporal difference will be 20, but deductible. The temporal difference will be 20, but deductible there. The temporal difference will be 20, but deductible. Then we go to last. On 1st April 2020, Huruma Limited deferred tax account nil balance, assume the corporation tax rate of 30%. Therefore, you give me the net temporal difference. You give me the net temporal difference. You give me the net temporal difference. Net temporal difference. $13.6 taxable. 13.6 taxable. Thank you very much, Ruth. Then my deferred tax equals to 13.6 times 30%. Therefore, my deferred tax times 4.08. 4.08. That is my deferred tax. 4.08. That is the tax liability that the examiner wanted. 4.08. Now we look at the movement in deferred tax quickly. The movement in deferred tax. Now, movement in deferred tax, it means how do I report the tax liability? How do I recognize tax liability and tax asset? Tax expense. How am I going to recognize the tax liability? Now, whatever we have computed here is the tax liability at the end of the year. It's always tax liability. Tax liability is always the tax liability. But the expense, we check on the movement of deferred tax. Like here, I prepare deferred tax account. Balance brought down. Examiner said we had zero balance. We had zero balance. Then at the end, balance carried down, we are having 4.08. That is the balance we have at the end. Therefore, my tax expense during the year equals to 4.0. This is my tax expense, and this is my tax liability in the balance sheet. My balance. But if there was, for example, a figure here, you compare the movement Any difference from the opening balance to the ending balance is what will go to the income statement as the tax expense. Now, let me give you questions that you will be doing. Questions. Question number 1. Question 1 is May 2017, question 4. Question number 2 is the November 2019. I don't know the question, but it's there. Question 4 or 5. Then question number 3 is August 2022. Then last question in number 4 is the December 2023. Therefore, you are going to practice those questions. When we meet in our next class, we are going to pick one question, we do it, then we go to the next topic, which will be financial assets and financial liabilities. Therefore, next class, we do one question here, we analyze the concept, then we go to the next agenda. Let's meet on Friday, God willing, from 7 to 9 p.m. Thank you for your time. Thank you for your patience. I pray that God will give you good health so that we meet in our next class. Thank you very much. Be blessed. Be blessed.